Imagine waking up one morning and noticing something strange on your street. One house has a mortgage warning letter, then another, then another. Within months, whole suburbs begin to change. For sale signs everywhere, price cuts, auction failures. Families who thought they were safe are suddenly fighting to hold on. This is not the US in 2008. This is Australia right now. Mortgage stress is already rising, fixed rates are expiring, insurance costs are exploding, and wages have not caught up. In this video, we're counting down 10 Australian cities and regions where mortgage pressure is becoming dangerous based on income, debt levels, job risk, insurance costs, and housing supply. This is not about fear, it's about understanding the numbers before they understand you. Let's start with number 10. Number 10, Gold Coast, Queensland. On the surface, the Gold Coast looks perfect. Beaches, sunshine, high-rise apartments, lifestyle. But behind the image is a serious financial problem. The median dwelling price is now around $900,000, while median household income sits near $68,000. At today's interest rates, servicing a mortgage at this price level requires well over $200,000 in household income. That gap is enormous. The Gold Coast economy relies heavily on tourism, hospitality, and casual work. These jobs are vulnerable and usually don't pay high wages. On top of that, insurance costs have become a major issue. After repeated flood events, many areas have seen insurance premiums double or triple in recent years. Some homes are becoming close to uninsurable. When mortgage repayments rise at the same time as insurance bills, something has to give. Listings across Queensland have been climbing, and days on market are stretching out. That tells us sellers are becoming more motivated while buyers are pulling back. Lifestyle alone does not pay a mortgage. Number 9. Geelong, Victoria. Geelong became the escape valve for Melbourne buyers. Prices surged more than 30% in just a few years. But by late 2024, something changed. Nearly every Geelong suburb recorded price declines. When almost an entire city is falling at once, there's nowhere to hide. Median prices sit around $730,000, with median household income closer to $72,000. That gap is unsustainable without ongoing migration and cheap credit. The local economy is stable, but wages are capped. There's no tech boom coming to save homeowners. People who bought late in the cycle are now facing falling values and higher repayments at the same time. That's when stress turns into forced selling. Number 8. Newcastle, New South Wales. Newcastle was marketed as Sydney's affordable alternative, but the maths never really added up. Median house prices reached around $850,000, while median household income is close to $78,000. That puts the price-to-income ratio near 11 to 1. During remote work, this worked. People earned Sydney salaries while living further away. Now, companies are calling staff back to the office. Commutes are expensive, and Newcastle wages cannot replace lost Sydney income. Listings are rising. Days on market are increasing, and buyers are comparing Newcastle prices directly with outer Sydney suburbs. If prices are similar, most buyers choose proximity to jobs. Newcastle is still a great city, but great cities can still be overpriced. Number 7. Hobart, Tasmania. Hobart is often seen as a bargain city after prices fell nearly 12% from their 2022 peak. But lower prices don't always mean safety. The median dwelling price is still around $650,000, while median household income is only about $72,000. Even after the correction, affordability remains badly stretched. Listings are up sharply compared to the long-term average, and Hobart now has some of the longest days on market in Australia. The local economy depends on tourism, government, and agriculture. These sectors provide stability, but not strong wage growth. Many buyers moved from mainland cities during the pandemic, bringing bigger mortgages into a much smaller wage economy. Now interest rates have normalized and those numbers no longer work. People are stuck. Selling locks in losses. Holding drains cash every month. That's a dangerous position to be in.
Number 6. Perth, Western Australia. Perth often looks strong when the eastern states slow, but Perth is a cycle city. Mining drives income, and mining is volatile. While median incomes are higher, the median dwelling price, around $730,000, still requires far more income than most households earn. Recent job losses in mining and processing sectors are a warning sign. When mining slows, Perth housing usually follows. During the last mining downturn, prices fell around 20%. This time, household debt is higher and interest rates are higher. That makes the downside risk bigger. If you're enjoying this, hit like to help more people find this video.
Number 5. Adelaide, South Australia. Adelaide once was Australia's most affordable capital. That reputation disappeared quickly. Prices rose nearly 50% between 2020 and 2023, but incomes didn't. The median dwelling price is now around $780,000, while median household income remains near $68,000. Saving a deposit now takes over 11 years for many households. Fixed-rate loans from the boom period are expiring right now. Repayments are jumping dramatically. Investor confidence is weakening and listings are starting to rise. Adelaide didn't become expensive slowly, it became expensive very fast, and rapid price growth without wage growth creates risk. Number 4. Brisbane, Queensland. Brisbane boomed during interstate migration. Prices jumped more than 60% in a short time. Now migration has slowed and supply is rising. The median dwelling price is about $860,000, while median household income is around $85,000. Outer suburbs like Logan, Ipswich, and Moreton Bay are under the most pressure. These areas saw the biggest price rises, which usually means the biggest falls. Flood risk has driven insurance costs sharply higher. Investors are starting to exit, especially apartments, as rental conditions soften. When investors sell into a cooling market, prices fall faster. Number 3. Canberra. Canberra is often seen as one of Australia's safest housing markets. High incomes, stable government jobs, low unemployment. But affordability is still a growing problem. The median dwelling price is now around $1.07 million, while median household income sits near $95,000. At current interest rates, servicing that mortgage comfortably requires close to $190,000 per year. That gap matters. Canberra's job market is heavily concentrated in government and government-related roles. When budgets tighten, contract work slows, and household income becomes less flexible. At the same time, apartment supply has increased in inner areas, which is easing rental pressure and limiting price growth. Investors who relied on rising rents are now facing higher repayments with less income growth. Mortgage stress in Canberra is not loud or sudden, it builds quietly, and quiet stress can still lead to forced selling when savings run down. Canberra is not immune, it is simply later in the cycle. Number 2. Sydney Western Suburbs. Western Sydney is ground zero for mortgage stress. Postcodes like Campbelltown, Liverpool, and Blacktown consistently rank among the highest stress areas nationally. House prices often exceed $900,000, while household incomes are commonly below $80,000. Transport costs are high, living costs are high, and budgets are already stretched. When repayments jump from low fixed rates to today's rates, increases of $2,000 to $2,600 per month are common. That is not something most families can absorb. One shock is enough to break the system. Number 1. Melbourne Inner Suburbs. Melbourne sits at the center of Australia's housing pressure right now. By late 2024, around 80% of Melbourne suburbs recorded price falls. That tells us this is not isolated. It is citywide.
The median dwelling value is now roughly $1.06 million, while median household income is about $82,000. At today's interest rates, servicing that mortgage comfortably requires close to $185,000 per year. Most households simply do not earn that. Inner-city Melbourne has a large apartment oversupply. Vacancy rates have risen. Rents have softened. A growing share of apartments are being sold at a loss. At the same time, Melbourne's outer suburbs are under severe strain. Long commutes, high transport costs, homes that are expensive to heat and cool, and budgets that were already stretched before rates rose. Many households bought between 2020 and 2022 on very low fixed rates. Those loans are expiring now. Monthly repayments are jumping by $1,800 to $2,500. When prices are falling, refinancing is difficult. When prices are falling, selling often means losing the deposit. That leaves people trapped. Melbourne also faces pressure from a slowing construction sector, builder failures, job losses, delayed projects. Melbourne is under pressure not because of one problem, but because every part of the market is adjusting at the same time. That is what makes it so important to watch. This is not about panic, it's about preparation. Across Australia, more than 1.5 million mortgage holders are now considered at risk of stress, according to major surveys. This is not a future forecast, it's already happening. The question is not whether the market will change, it's where and how fast. If you found this helpful, like and subscribe for more property insights.